Shah joins us, President with the Shalby Group of Hospitals, to understand how things have gone for his company for the quarter gone by. Good morning. Thank you for joining us. If I look at your numbers, margins, well, they've remained flat, whereas on all other parameter, which is EBITDA and revenue, there is a growth. So should we really take a deep dive into these numbers and understand that when business is growing, why are margins coming down?
Good morning, Nikunj. Thank you for having me. Yes, the performance has been quite strong on all parameters. And in fact, we are looking at 20% kind of growth in the revenues and the EBITDA. We've also achieved a 20% kind of ROC level in the hospitals business for this quarter. So we are quite happy with the performance. The margin expansion, with regards to the margin expansion, we have continuously been investing in building newer specialities in terms of capabilities. And, because of that reinvestment, into the business for further growth, we do see that, the margins have remained flat. However, with some of the drives that we have initiated over the last 3 months, we will be seeing a margin expansion, towards the second half of this year. In fact, from Q2 onwards.
So, Shanay, the best way of looking at the growth of your company or your hospital chain, should one look at occupancy rates? Should one look at capacity addition? Should one look at international footfall? Because this is one sector where there are a lot of variable factors which are at play.
So I think the biggest upside, Nikunj, in Shalby today is in the hospitals business is really, the kind of occupancy ramp up that is possible and that what we have achieved. So one is, of course, the fact that, yes, the volume growth has been more than 13% year on year and much higher on a quarter on quarter basis. But also the ARPOB growth, the average revenue per occupied bed, if you see, has grown by 8%. So we are inching close to 40,000 rupees, as an ARPOB now, which is very high for, given the kind of towns and cities we are present in. So, it will be twofold really in the hospitals business. And of course, some of the newer businesses, we'll be seeing a much higher growth, like the implant business and, the franchisee business, you'll be seeing a much higher growth. Like, just to give you an example, in the hospitals business, some of the mature hospitals have grown by higher double digits, but most importantly, some of the newer facilities like Mohali, Jabalpur, Surat, Naroda, these combined have a capacity of about 1,000 beds, and we have grown 50% on the revenue year on year, and the EBITDA has grown fivefold on a year-on-year basis in these units.
Okay. So what is the guidance for a new bed addition in the existing capacity and pure greenfield expansion?
Well, as you know, we already have 2,000 beds as a capacity, and we already are kind of at an occupancy level where we can see a good 20% kind of growth year on year for next 4 years without doing any capacity addition. So that is on the existing capacity side. We have two new facilities coming up. One in Mumbai, which is the Santa Cruz Hospital, about 175 beds, and the other one in Nashik. So these two are the announcements that we made on the multi-speciality hospital front. These will come into play close to 24 to 36 months from now.
I just want to understand the big picture for the hospital industry. This space is getting interesting, brutally competitive, and it's a space where right now PE investors have also kicked in order to bring in efficiency. What will happen to the hospital space when you've got multiple hospital space who are expanding and they're getting access to PE companies and they're getting access to equity capital? How will the industry dynamics change? Because this is an industry where very interesting positioning now clearly is at play.
So Nikunj, you're absolutely right. This is once in a century kind of opportunity. It's a decade opportunity that, we feel we have. And, this is kind of also stamped by all the FIIs that have been investing in as strategic partners, also as silent partners into these businesses. It gives us a lot of confidence. Having said that, yes, a lot of new capacity needs to be coming in because most of the strategic partners have been taking over existing assets, but there is a huge potential to build newer assets as well. So which is where Shalby is focusing on. We are looking at inorganic as well as organic opportunities, because we believe that the run up over the next 1 decade is going to be significant in the hospital space.
ROS, a number which institutional investors they always look at, it is at an enviable rate of 30%. 30% is what even FMCG companies don't command. Now, for a business which is capex dominated, for a business which has cyclicality, for a business where operating leverage benefits have not kicked in, how are you managing 30% and will it sustain?
Sorry, did you say 30% EBITDA margin?
No. You mentioned to me at the initial part of your question that your ROS, ROE.
Yes. Yes, the ROCE, Nikunj, for us in the hospital business is 20%, which is much higher than most the industry average. And at this point of time, we are still at a capacity utilization where we can really kind of double the top line in the hospital business. So when we really ramp up, you will see these ROCs inching close to 30-35 odd percent. So these are quite significant in nature.
It becomes 30, operating leverage benefit would kick in. Will that happen in FY24? Will that happen in FY25?
No, we'll start seeing this, Nikunj, over FY24 as well. And we'll see it inching up over the next 3 to 4 years, because as I said, there is a significant upside which we have. So, we look to add 1.5%, to the EBITDA every year as a additional margin that we'll be looking at because of the margin expansion and operating leverage, as you did mention.
Okay, great to join you on the show, Shanay. Thanks so much for taking the time out.